everyone, this is Abhijit Chatterjee recording our weekly session of Charts are Fun. This is for the week of August 17th, recording this on Saturday, August 22nd in the afternoon. Our Substack site is chartsarefun.substack.com. We appreciate you subscribing to the site, and it's free, and we send out daily blogs. And it'll be emailed out to you around 7 a.m. in the morning when it comes out in the East Coast time. And then our YouTube channel is also Charts Are Fun. We do believe there are tremendous fun insights in these charts. We are not registered investment advisors. Our goal here is to really share these fun patterns in charts and help you guide your investment decisions. Today, we're going to focus on a key earning. The earning season winds down, but a key barometer earnings with the king of AI, NVIDIA, is coming up this Wednesday. So this is on the 26th in the afternoon. NVIDIA, as we know, has been hugely benefiting from the CapEx spending by these hyperscalers, people buying GPUs like no tomorrow. The CapEx spending is projected to cross almost $1 trillion next year by 2027. $1 trillion of CapEx spending, at least 40% of that lays out to NVIDIA. So pretty much market expects a 400 billion run rate and even higher for NVIDIA in the next like 1 year or so. This quarter that's just ended in July that they announced earnings, market expects 92 billion of revenue and about $2 of earnings per share. We'll see what they do, but looking at the tea leaves of the daily chart, we can see a beautiful W-shaped double bottom at 190. We can see that the first time it tested it was in late June, and then in late July it tested that number again at 190, slightly higher than the previous low. 189.8 was in late June and 190.01. And as that second bottom of 190 tested, we see higher low in MACD. That's a positive divergence. That typically signifies an upward move, upward reversal from this W shape. So the W shape, as we can see, the tip of the W is at 214 from a 189.8. Roughly, we're talking about what, $24 or so, $24 and 59 cents or so added to the 214. That takes it closer towards 239. We see that it recently gapped higher towards early August. From there, it pulled back. It's coming down to kind of close out that gap near 213 or so. But in the next few days, if earnings is strong, we could expect the reversal higher towards the 239. So that's the NVIDIA's daily chart, and the measured target on the W, takes us towards 239 is what we think, this move could be. Then if you look at the medium term chart, this is like the last 4 years with the weekly, every candle is a week. We do see negative divergence as NVIDIA has been climbing higher highs. RSI is printing lower highs. That is a bearish pattern. That said, we also see a near-term pennant formation. Near-term as in intermediate-term pennant formation. We join the higher lows, that's a trend line, and then we join the lower highs, that's a trend line. We could get that breakout if the 239 number comes to test that previous high from the kind of May time frame at 236. We could get that, but then there's a good chance that could fizzle out and NVIDIA could head lower. So if we do get this upside towards 239, that could be a good selling opportunity. Please, looking at this weekly chart, clear negative divergence in RSI, clear negative divergence in MACD, printing lower highs. If we do get the breakout could be temporary, and then perhaps a decline could follow after that. So that's what we're going to be cautious about. That said, the NASDAQ 100 ETF QQQ, if you look at its near-term pattern, it tested and bounced off a key support at 708. We see that on August 4th and 5th, it went to 728, and in a very quick fashion, moved a $20 up and a $20 downside move. So 708, 728, back to 708. Then a head formed from 708 to 734. We came back to test that 708, right about that 708.50, 708.52 within 2 cents. And then rebounded to 715, closed near 711. Potentially, we could see a little bit of upside this coming week with NVIDIA's earnings with some expectation of a snapback. But then this could turn out to be a head and shoulder pattern is what's possible. because if this forms a lower high from the 734, maybe matching the symmetry of the left shoulder at 728, maybe it even comes to close that gap near 730. If you do that and then head lower, a 708 to a 734, you're talking about $26. Subtract 26 from 708, that takes us to 682. Potentially, that's the head and shoulder near term. This is an hourly chart that we're showing you. Every candle is an hour. So this could be a snapback bounce for a few days next week, and then we could get the breakdown. Also, if you look at QQQ's weekly chart, this is what we call as a broadening wedge in a descending fashion. A broadening wedge in a descending fashion usually is a bullish pattern, assuming it shapes up at the bottom of a trend. This is at the top of a trend. We've been climbing since that late March low, and at the top of the trend, this kind of a pattern. If this breaks lower, we already see that on last week we got what we call as a bearish engulfing candle. The entire candle for the week took over the body of the previous week's candle. So this red candle body took over the white candle body of the previous week, engulfed it. That's why it's called engulfing. Why it's bearish engulfing? Because it closed red. It opened higher the top of the candle for the week and ended towards the lows of the candle for the week. So that was a red candle, and this bearish engulfing typically signals downside. We saw the last time we got that bearish engulfing was in the June time frame, and from there early June, that bearish engulfing then signaled downside move, and for the next several weeks it came back and tested the this broadening wedge bottom trend line. We could now, see it's broadening, so we could now easily come down to test the rising 50 period moving average, in this case the 50-week moving average at 642. That's also where the the broadening wedge bottom trend line meets the lower trend line. So that trend line with the 50-week is at 642 at minimum. We can expect that, and if that breaks down further, we wouldn't be surprised to see it go back and test maybe even the 634, 635 is a key. What was resistance is now support. Maybe it could just hold that and climb higher. It's possible because the market overall has very bullish fundamentals in semiconductors, tremendous data center spending, tremendous semiconductor buying, and momentum is there. So if unless something with the geopolitical environment, or we're going to talk soon about kind of the project twist that Secretary Bessent talked about, Scott Bessent, about selling short-term treasuries and buying long-term treasuries because those yields have been spiking to control those. But if those yields continue to climb, that could be bearish and that could cause further downside in the market. But this kind of pattern could turn out to be a bearish resolution in the next few weeks. We know September is typically a bearish month, seasonally bearish month, and we could see that downside shape up. In at least a 10% correction can be ruled out. So a 10% from 713 to maybe if it goes up to 728 for that left shoulder bounce and then comes lower, that you're talking about roughly $70 or so from a 730. That's roughly 660, and we can see here that 642 is with the rising 50 period. Or a test of the rising 50 period like we saw in March is possible in the next few weeks. S&P 500, interesting enough, also printed a bearish engulfing candle. You can see that the red candle for last week, the body took over the body of the previous week, which was a much shorter body the previous week, but this entire week's body engulfed the previous week's body. It ended down 1.4%. We see that the QQQ ended down 2.4% for the week. S&P 500 ended down 1.4% for the week. Higher high in price, lower high in RSI. That's classic negative divergence. Same thing with QQQ. Higher high, QQQ did not print a higher high in price. So that is why we call this as the broadening wedge. The declining highs and declining lows. So lower lows, lower highs was the pattern that QQQ had. S&P, however, had a higher high. From 76.20, it went up to a higher high at 78.16. But look, RSI is at a lower high. So that's negative divergence. If the decline happens on S&P, we could get pull back towards 7,026. A 10% on S&P is also quite a possibility. Some key indicators next we're going to talk about that give us some feeling that potentially we are setting up for a pullback in September. is one of the market breadth indicators. We keep hearing in the market that, oh, there is tremendous broadening out in the market. If there is broadening out in the market, why is it that the New York Stock Exchange Summation Index, which gives you the overall market breadth, declining? We can see that in the climb of the markets from the November lows to end of February, we had higher highs in the summation index. It was climbing higher. That's the trend. Look at the trend now. From that snapback that we got from late March low till early May, from there we are printing lower highs. So that's the declining. In fact, it's declining all the way from the high of late February to a lower high to a lower high. Now, if you take a broader view, not just the near-term view, but if you take a broader view, we can see that this kind of lower highs goes all the way back to 2024. So 2024, we see 1112, then we see 937, then we see 696, and recently lower highs at 476. So this shows market breadth weakening, not the broadening, not market breadth improving. It shows market breadth weakening. Also notice that the lows are higher lows. So at some point we are coming to a convergence, and the key is the moving average in blue, which is the short period 50 period moving average, is getting ready for a bearish cross below the 200 period moving average in red. That bearish cross also indicates potentially a breakdown in the summation index. Breakdown of the summation index could take us to a lower low below what we saw in March at minus 322. A caution for us to be thinking about. This is something, is a red flag. This bearish crossover in the moving averages with the summation index kind of coming to a point where it's come very narrow, and we could get a volatility move. We could get the summation index heading lower, which would mean market selling off, which would mean market breadth weakening. Way more decliners than advancers. That's what the breadth here is. Summation index is about advanced decline. More decliners than advancers could cause us that negative level that we have seen in the past in the 2025 tariff low and in the most recent end of March Iran war low. So that's a possibility. If we could break below this level and take a lower low, is a possibility in the next few weeks. Another indicator that's a concern is the fear gauge VIX, the volatility indicator, is printing out a falling wedge pattern. A falling wedge pattern typically indicates a reversal higher. A reversal higher in volatility is not good for the market. That would indicate a market correction as well. So we can see here that if you join the lower highs and you join the lower lows, that's converging to an apex at a point where we could now get a volatility breakout higher. That volatility breakout higher at minimum could come test that 30-31 level from the late March, potentially even break higher to retest that 35 and maybe even towards the 40s. 60 is kind of an unlikely. That was a very abrupt event that we saw from the tariffs. That's unlikely, but at least a retest of the 30 to 35 in the next few weeks, in the next month, is very much a possibility for us to be thinking about and for us to be cautious about. So volatility with this falling wedge pattern is a concern. And finally, what was in the news last week was Scott Bessent's intervention message. He hasn't started the intervention, but he said he's going to do it from September through November. And that intervention would mean buying long-term treasuries to bring the yields down. He has panicked seeing the 30-year treasury on an upward rising trend. When it hit that 5.3% is what caused him to kind of panic and make a decision to start buying long-term treasuries to push the yields lower. So that is on Wednesday when he announced it. It fell sharply towards 5.18%. Then Thursday and Friday, the market resumed its climb. So this is what we're going to watch. There is a cup and handle pattern on this TYX, the 30-year Treasury yield chart. That cup and handle from the left rim at 51.97, the bottom of the cup at 48.23, up to 51.93. That's a 3.7 or so is the depth of the cup. Add the 3.7 to 51.93, that takes us to 55.63. 55.63 is a 5.56% 30-year Treasury yield. That would not be very welcome by the market. That would effectively cause, already we can see that we did get a pushback at the 5.32, pushback by Treasury, making that statement they're going to buy long-term Treasury, but the market ignores his message and continues to sell off Treasuries with the yields climbing. That's potentially one of the factors that could cause the market's correction. So in summary, NVIDIA is gearing up for a nice double bottom, W-shaped double bottom up higher. The target is towards 239. It has pulled back to close near below 215 at 214.72 on Friday. Next few days, the earnings is on Wednesday. If it, market likes their earnings and their projections, at upside towards 239 is very much possible to meet this W-shaped technical target, double bottom technical target. That said, NVIDIA's long-term chart from a weekly chart we can see is printing negative divergence in RSI and MACD, and there is this pennant shape pattern. We could get a temporary break from the pennant shape towards the 239. That could be a fake out break, and then the break below is very much a possibility looking at that negative divergence in RSI and MACD. So for us to be cautious about, if we do get that upside to NVIDIA towards 239, wouldn't chase it any higher, would start taking profits or even setting upside covered calls for preparing for some downside in NVIDIA. QQQ, the NASDAQ 100 ETF, near term is sprinting a head and shoulder on its hourly chart. A right shoulder move to test the left shoulder towards 728 and close out that gap near 729, 730 is a possibility and could happen with NVIDIA's earnings. And then maybe as the market sells off, we could, and the key event next week coming up is Jackson Hole. We have our FOMC chair, Kevin Warsh, his first Jackson Hole. We shall see how he signals, but any kind of hawkishness from him, indications for a rate hike, could cause the market to sell off as well. So that's something for us to be looking at. And that's on Friday. NVIDIA earnings is Wednesday. So we could get a Wednesday into a Thursday, nice upside move of NVIDIA. Then with the Jackson Hole on Friday, from Friday on to next week, the week after, be prepared for downside as we head into September is for us to be watching for and be careful about. QQQ's weekly chart has what we call as a descending broadening wedge pattern. This is typically bullish in the bottom of a trend. This is at the top of a trend. This could turn out to be bearish. That decline towards the low end of that trend line takes us towards the 50 period moving average at 642 is potentially possible for a QQQ to head back and test that, rising 50 period moving average. S&P 500 in a similar way printed a higher high with a lower high in RSI. That's classic negative divergence. It could pull back to test its 50 period moving average near 7,000. So 10% on S&P is quite a possibility. Some key indicators, technical indicators warning us that we could be heading for a market correction is the market breadth deteriorating. We can see the summation index printing lower highs as the market climbed to higher highs. So S&P here climbed higher highs, but the summation index printed lower highs. If you take a longer term view of summation index, these pattern of lower highs goes all the way back to 2024. Late 2024, we had peaked in the summation index. Since then, the market breadth has been deteriorating. Key is this bearish signal of death cross of the 50 period going below the 200. That could indicate a downward trend in summation index coming, which means market breadth. Summation index is defined by advanced to decline cumulative number. As there's more declines than advancers, we could see this negative value. We could see it break below. We can see a pattern of lower lows, minus 153 last year to minus 322 in March. We could now get even a lower low. And in that case, this could indicate not just a 10%, maybe a slightly higher correction in the weeks ahead. Volatility is printing what we call as a classic falling wedge pattern. Falling wedge patterns reverse higher. So if this reverses higher, this could indicate some form of a volatility squeeze or volatility spike coming in the next few weeks. And that could time very well with the market corrections for us to look into. And the 30-year yield could be the catalyst for it. It has broken out from a cup and handle pattern measured to 5.56% on Wednesday when Scott Bessent announced the intervention with this Project Twist, which meant selling short-term treasuries and buying long-term treasuries to help bring the long-term treasury yields down. It fell sharply that particular day on Wednesday, but then to Thursday, Friday, it recouped those losses and even closed higher than the open on Wednesday. So this indicates the market could ignore the intervention and continue to sell off the bond market. The bond market, as we say, smarter money. Smarter money is concerned about US's $40 trillion of national debt, is concerned about the deficit, the budget deficit over $2 trillion. So market could sell off in the bond market, taking yields higher, and that could in direct fashion impact the stock market, causing it to collapse downwards as well. With that, thank you for listening in. We wish you all a very safe investment time period in the next few weeks. Be prepared for volatility, be prepared for some market downside, and just be careful out there. Thanks for listening. We appreciate you hitting the like button if you liked the video. Thanks so much.
We are not registered investment advisors and encourage our users to consult with their financial advisors before making investment and trading decisions. Nothing contained in our content constitutes a solicitation, recommendation, endorsement, or offer by us at Chartsarefun or any third-party service provider to buy or sell any securities or other financial instruments in this or in any other jurisdiction in which such solicitation or offer would be unlawful under the securities laws of such jurisdiction.